All right, everyone. So what we have here happening, as of right now, there's a short at 14.23 based on the Atlas line trade. Excuse me, everyone here who has the Atlas line, I'm not sure how many people here have the Atlas line. Finley, excuse me, I think Finley has the Atlas line. We should all be getting the same exact entry at 14.23. And now the reason why we have this entry at 14.23 to go short is very simple, because we have two consecutive closes. This would be 1, and this would be 2. So even though the software plots the entry 14.23, I want you guys to know what exactly the entry is. The entry is the close of the second candle. So the close of the second candle happens to be 14.23. That's the entry to go short. All right, anyone have any questions? All right. So I'm looking at trading price and price action as it revolves around the Atlas line, not the other way around. How most indicators work is that, you know, two lines cross, or the indicator goes below 0 or above 0. So really the idea here is a little bit different. It's looking at price action and the candles, and what are they doing? Now there's pullback, there's strength trades that go along with this. But the main focus is this double bar long and double bar short trade. Today happens to be double bar short to go short. Okay. Now this webinar, Finley, we're going to concentrate on the Atlas line. You can send me your questions for the power price action via email. I think you sent me an email yesterday, the day before yesterday. I'll be happy to look at it, look at your chart, and review it. All right. I'm going to go over the next year, what's going to happen in 2013. I will, Walter. Walter wants to know here, what's the difference between the at the open or the Atlas line? I will, absolutely, Walter, no problem at all. Still looking at the ATO, absolutely. Well, if we have an at the open trade follow, I'll show you what it is. So definitely, we're still looking at the open trade. The ATR, right? Got to use that ATR. So let's add the ATR. The ATR I want to use is 4 or 5. Usually I like 4, last 4 bars. And so what this does is it tells me what are the current, what's the current situation. 2 1/4 points. I always round down. So I know that 2 1/4 points is really what the market can do from this point on, up or down. 2 1/4 points. So I need to know what the current conditions are. Is it slow? Is it fast? All that good stuff. Yeah, if there's a news event, Finlay, absolutely. If there's a news event happening at 10 o'clock, my recommendation is you don't know what's going to happen, right? The market can go crazy to the upside, to the downside. So I just don't know. So if there is a news event, I have to check the Bloomberg. I don't have the news indicator up on my chart. But just be very careful with news, okay? Because it could be very chaotic at that time. All right, so let's begin here. The questions that I'm getting in. Hey, good morning, Babek. The questions that I'm getting in here are asking me what's the difference between the Atlas line and the at the open method. Someone who can only trade in the morning. Thanks, Mike. There's a news event here at 9:55, 10 o'clock. Thanks, Finley. So I'm going to give you a little bit about myself, my background, the type of trading that I like to do, and then we'll start looking at some charts and things and methods. For a very long time, I've been using price action to trade. And I don't like to use a lot of indicators. I don't like to use a lot of things that confuse me, right? A lot of traders that I talk to, they have a lot of indicators on their charts, multiple time frames. And so, yeah, so, you put all these things on your chart, and you're looking at this wealth of information, and really, when it comes down to it, you don't know what to do. You don't know whether you should go long or short, for how much. And so what I want to do is I want to simplify this. I want to teach you guys how I interpret what's happening in the market. If the market goes up, I'd like to see some evidence of it, some proof. If the market goes down, I'd like to see some evidence that the market's going to go down. I want to put some objective, hard and fast rules to it. And then I want to manage it accordingly. Right, exactly, Bob. Paralysis analysis, right? So it doesn't have to be complicated. A lot of traders make it overly complicated, and sometimes I do as well, right? You get a phone call from somebody that is in a mentorship program the other day, and he says to me, I have the MACD on, and it's telling me that I should go short, but the moving average is now long, and something else stochastic is overbought, and on the monthly chart and a daily chart. All right. So you have all this information, but how do you analyze it? How do you know what to do and when? So I, have to kind of say, okay, calm down. What do you see in your chart? And he says, well, the price is above the outline or below the outline. Okay, so that one thing that you see, price is below the outline, like it is right now. I know that the bias is to sell or to go short until something changes, right? So you don't have to have 10 things telling you, what's happening. If you just have one or two things maximum, focus your energy on that, and then manage the trade properly. So I'll give you an example for right now. Right now, the price is below the Atlas line. And therefore, my bias, any trade that I take, when I'm just referring to the Atlas line, is going to be a sell position, a short position. It doesn't mean that I'm just going to jump in. It just means that I know the direction that I want to be in. Now I have to pinpoint an entry. It could be the double bar short. It could be the strength trade. It could be the pullback trade. It could be a variety of different entries. But I'm already halfway there. I know that I want to go short. Now, what would change that? Why would I decide to go long? Or, what would really cause that to happen? Well, when I look at price, and I look at the Atlas line, I say price is below the Atlas line, so, I'm looking for short trades. But if we had a candle that closed back above the Atlas line, then I'm no longer thinking short, I'm thinking long, right? So using proof, I'm really big with proof. If this candle right now shoots up and closes above the Atlas line, there's my proof. I shouldn't be short, I should be now thinking about long, but I have to manage and these setups properly. So what are the setups that I use? I have a variety of setups. They're all based off of price. I don't use any conventional indicators. The Atlas line is a proprietary tool, software, but it's more than just an indicator, right? It's more than just an indicator, right? Think about, how price moves, right? Price goes up, price goes down. Price does nothing. Sometimes it ranges. If you can isolate those things and then put some rules to it, that's really all you need. Now, the double bar short that you see here, I mentioned it early in the beginning of the webinar. It's very simple to know when this is going to happen. You don't even have to have this occur. You can have, as I do, price telling me and having some proof. So I have 1, 2 consecutive closes, and this closing price tells me that there have been 2 consecutive closes below the Atlas line. I should now think about going short at this closing price, and it corresponds to this entry, 1423. So it has to be clear, it has to be objective, it also has to be something that you can verify on your own, not just sit here and wait for this thing to pop up and say, oh, I got to go short now. You should know more or less when it's time to go short. Just pinpoint this exact entry to this closing price. Anyone have any questions on that? Okay. Now, this short at 1423, if you go short, if you're short, how do you manage this trade? It's not that difficult to put management rules that make sense. It's got to make sense, right? A lot of traders hold on to trades for 3-4 hours, hoping that it's going to go back in their favor. Other traders, have very tight stops, right? So let's kind of look at how you manage a trade properly, okay? So the first thing that I want to do is I want to say to myself, if I go short at 1423, which is the closing price of the second candle, where's my stop, right? Where's my profit target? The very simple question, and believe it or not, a lot of traders don't know the answer to this. And I'm amazed, because before I enter into a trade, I need to know what my profit target is before I enter, and where my stop is going to be. Now, you can't place a stop that is too close to the market. As a matter of fact, you can't have a stop or a profit target that's always the same. Some traders do. But I think that you should be dynamic. You should look at it and say, what are the current conditions? And based on the current conditions, this is what I'm going to use to put my stop or put my profit. So instead of just hoping that it's going to get to 5 points, or hoping that it's going to make your 2 ticks, 3 ticks, or 1 point, whatever you want, at least know where you stand. Now, what is the market doing? So I use a tool. It's actually found in your indicator list, called the ATR, the average true range. I'm sure that everyone here, almost everyone, if you've watched my videos, if you've followed kind of what I have to say, you know that I use this a lot. I use this to tell me, I use this to tell me what's happening now. Not what happened yesterday or 3 days ago or 3 hours ago. What's happening now? So this ATR, whatever platform you use, whether it be Ninja, TradeStation, or MT4, or whatever it may be, know where you stand. So this trade here at 1423, the first thing I do is I look at the ATR. Right? This ATR says 2.66. So I'm going to round down. And remember, this is a scale in points based on the E-mini S&P. But in other markets, they are in ticks. So if you're looking at this on the euro, if you're looking at this on the Australian dollar, or bonds, or soybeans, whatever it may be, the scale may not be in points, may be in ticks. So you have to definitely just know, okay, what am I looking at? Is it ticks or points? It's simple. It's not that hard to understand. This is points. 2.66 happens to be 10 ticks. right? 2.5 points is 10 ticks. So I know that 10 ticks, 2.5 points is what I'm looking at. So if I put a stop at 1 point, just the random market movement up and down and up and down is going to stop me out. So I know, based on the current market conditions, that 2.5 points is what this market can do from this point on. So you can't have a stop less than that. You have to have a stop larger than that, so you don't get stopped out prematurely. I also use the ATR to tell me the profit target. So I use a ratio of 1 times the ATR. Okay, so if the ATR is 2.5, as it was on this at this point right here, I know that I'm looking at 2.5 points. Now, if the market happens to get shrink, right? Remember, I'm using a setting of 4 on the ATR. The last 4 bars, the last 20 minutes, the most recent market conditions I want to reference. If this ATR begins to get smaller, I'm going to adjust the profit target to less and less and less, okay? But if this ATR increases, it may increase against me in the opposite direction. So I'm not going to increase the ATR. I'm always going to decrease, I should say the profit target, decrease it based on this. So I know that 2.5 points is what I want. 1423, 1422, 1421, 1420, 50. If my math is right, this is where I expect the market to go. I want to go short, and there's my profit target, right? 1423, 1422, that's 1, it's 2, 2.5. Okay. So now you have this. And this moves. The next candle after it closes is smaller, and therefore it reduces the ATR by a tick. So instead of me looking at 2.5 points, I'm now looking at 2.25 points. So now what I'm doing is I'm managing the trade. So 1420, 50, 1420, 75. So what I'm doing is I'm managing the trade based on the current conditions, referencing the ATR. So if initially I wanted 2.5 because it was here, now the market is contracting or maybe ranging or whipsawing, whatever it may be doing. But now the last 4 bars, it's 2.25 point, right? 2.25 points, right? Hey, good morning, Camille. Okay. Yeah, I see that as well. Okay, so now this moves to 2 points. Right? So now I adjust my profit target to 1421, 2 points. Anyone have any questions on how this trade is managed? How you adjust the profit target based on the ATR. Okay? Very simple, but it keeps you out of trouble. Some traders even like to be more conservative, and they're always 1 tick in front of the ATR, and that's because sometimes it hits your profit target and hits and hits and hits and hits, and you don't get filled. So being a little bit more conservative is fine. All right, so anyone have any questions on that? So far, so good? Okay. Finley says, only move limit ATR when ATR changes or ready to get out of the market. I know you say do not do this too much. I get back of the line to get filled. That's correct. So what Finley says here is that if you're ready to get out of the trade, that's when you move your limit order profit target, because every time that you move your order back and forth, you get put in back of the line. It's called a first come, first serve scenario. Okay? Now, On top of the target, we have to talk about stops as well. So stops are also dynamic, and they have to be adjusted properly. If you have a one stop fits all scenario, then you're going to be in trouble, right? Because you're going to wait until the price gets hit on your stop. So I have a little bit different theory on this, okay? When you see a stop, don't think of a hard stop, and don't think of 1 point or 2 points. Think of a combination. So here's how I look at it. I look at a combination of stops, which is, first, I see a time-based stop. And this time-based stop tells me that if I'm in a trade for too long, for whatever reason I entered into the trade, it's now over, right? I entered because, I don't know, Bernanke was speaking, or I entered because price is above the Atlas line or below the Atlas line, or whatever the case may be. ATO trade, blueprint trade, roadmap, it doesn't matter. 3 hours later, you're still in this trade. What are you doing in the trade? 3 hours later, we should be doing something else. The reason why you entered is now history. So I look at a time-based stop and say 4 bars after entry, I should be looking at exiting the trade. It's 20 minutes of time that I'm giving as a day trader. It's almost an eternity that I'm waiting and waiting and waiting, and nothing's happening, or you're a little bit in the negative or a little bit in the positive. Excuse me, a little bit in the positive, or you break even. It's time to let it go. So I manage my trades with a time-based stop just to make sure that I'm not holding on to this thing forever. 4 bars, 20 minutes, more than enough time for a reaction to occur. Okay. I also use what's called a prove it stop. So on top of the time-based stop, I have a prove it stop. Okay, and a prove it stop tells me if I have some type of proof that the market is not going in my favor, then it's proof that tells me let me get out. So with the Atlas line, I use a closing price in the opposite direction. So if there's a closing price that occurs, if I'm short and we have a closing price in the opposite direction, then I'm out of the trade, right? Because I have proof that I shouldn't be there any longer. So I always use proof alongside a time-based stop to tell me whether or not I should or should not be in the trade. So the last part of this is a catastrophic stop. And these are things that I teach. Some of you may know this already, because I know that a lot of you here are students. A catastrophic stop is very important because when I place a trade, if there's an earthquake, I always say earthquake and terrorist attack, along those lines, things that are out of my control, there is no reason for me to not have a catastrophic stop in place. So each time that you trade, have some type of catastrophic stop, because if that market turns around and goes against you for whatever reason, news, somebody decides to sell big, I don't really care what the reason is, honestly, as long as I know that something's there to protect me. I can't let one trade devastate me. So a catastrophic stop is always in place. The one thing to remember about a catastrophic stop is that it can't be smaller than your ATR, right? Right, like a hurricane, right, Bob? Right? It can't be smaller than your ATR. It has to be always a little bit larger than the ATR. All right, that's good questions here coming through. All right. Now, somebody mentioned the ATO, right? The at the open method, right? I forgot who it was. I am going to show you the at the open for today, right? This is something that I teach in the mentorship program. It used to be available, but it's not any longer. $14.2450 is my entry to go long. This is my entry to go long. I still use the ATR. I think it was 2 points, was it? I wasn't paying attention. But 2.9. I'm sorry, 2.5. 2.5, 2 3/4. I would say be more conservative. 2.5. 2.5 is a big number. So, well, big number for what we've seen lately. But 2.5, 2 3/4. So 14.2450, 14.2550, 14.2650, 14.27. There's 2.5. It still went more, but we'll just call it 2.5, 2 3/4. Now, I still utilize the same strategy for management. I utilize, was Nathan. Was it you, Nathan? Okay. I still utilize a time-based stop. So if the ATO, nothing happens with the ATO, then I'm out of the trade. 4 bars later, I still utilize a catastrophic stop. There's not really a prove it stop with the at the open, but this is what the at the open was a little while ago. I didn't take this, guys. I'm, not trading while I'm doing this. Sometimes I do, but not today. All right. All right, very good, very good. So there was a question early on that says, what's the difference between the at the open and the Atlas line? The at the open is meant to take a trade right as the beginning of the day begins. It's a one and done type of deal. I like to look at the ATR to tell me what to do with it. The exact ATR in this was 2 3/4, so it definitely hit the 2 3/4. I think 2 3/4 is there. Okay. So I always look at the ATR and then I manage my trades accordingly. Okay. Now, one of the things that I put out in the newsletter was this January effect. Okay, I'm going to discuss this a little bit. Oh, range bars. Does it work with range bars? I don't have. What range bar do you like? Who asked me that question? Dave? What do you usually use for range bars? What's your... I'll put it up for you. I'll be happy to show you. 4? Okay, let's take a look at 4. 1 point. Range bar 4, right? And there's the at the open here at 14.2450. I am going to remove, though, the at the open. I'm going to show you the Atlas line. Set to 9:30, okay? Okay, so it's a little bit different than the 5-minute. You have here a short right here because you have 2 consecutive closes to go short. This obviously did not work. And then you have another short here, which is kind of just flip-flopping back and forth. And then you have a long here. So if I understand this correctly, the rules don't change, David. Everything is the same. 2 consecutive closes above or below, that's the entry. The management should be the same. Yeah, this trade, if you're using range, looked like that. Did not work. This, I think, might have been just a break-even trade. And then this one was a winning trade to make up what you lost here. Let's take a look at yesterday. I don't use range bars. I think they're a little deceiving if you look in history. I don't like to use them for that reason. Here is the yesterday, David, range bars on the Atlas line. There was a long that didn't work out. This short looks like it was a small loss. Here's a winner. Here is a winning trade. And then you have these pullback and strength trades in between to go short or long. I go back another day. So I don't really use this here. What is this? This is 12.19. Here is a short at 14.39.75. Here is a short and a long. The short, I think, see here, would have made 14.27. So here's your short entry right there. Right there, and here's your long entry. So it's not that bad. I'm just not a fan of range bars. Okay, Dave? Walter says here, what do you do when the... Dave, let me know if that answered your question. Okay. Let's take a look here. Walter says here, what do you do when the Atlas line is far from price, that the catastrophic stop is less than the prove it stop or price? It's a very good question, Walter, that you have. What happens when, as an example, let's just do something like this here. Let's say that this is the Atlas line, looks something like this, and you have one, and then you have two really large bars that tell you to go long 2 consecutive closes above. So your entry is all the way up here. The prove it stop is down here, right? And the catastrophic stop is, let's say it's here. What do you do in this situation? Now, I know that there's a few of you here in the room. Who would want to answer that? Because I do go over this in the training. I include live training with purchase of the Atlas line. And if anybody's interested in getting the Atlas line, I do have a holiday special. I forgot what the coupon code was. Chad, you know what the coupon code was for that? You want to Skype that to me, please? All right, thanks. I'll put it here in the room. 15% off any of the courses. Thank you, Chad. Good through this holiday here through the end of the year. You can use this coupon code. I'm not sure if that went through. I think it went through here. Let's take a look here. So the question that Walter had is, what do you do when it's so you know, above the Atlas line, where the prove it stop is smaller or larger than the catastrophic stop, and that's 15 holiday for that. Well, there is a way that I manage that, and I teach this. Finley says it's overbought. Finley's correct. Or you can look at another time frame, right? Very good, but Beck actually knows here. Beck is one of my students. If it's double the ATR, right, it's too risky. So the way, Walter, that I manage the trade is that I look at the ATR, and if the ATR is, let's say, 1.5, 1.5, if I'm entering 3 points higher than the Atlas line, so this is the Atlas line and this is 3 points above it, then I know that it's overbought, it's too risky, right? Finley and Babek, right? That's right, exactly right, Nathan. So for those of you who are my students, you guys are answering. Thank you, Finley and Nathan and Babek. Okay, so you always know, Walter, if the market is too risky or it's overexhausted. And you know, it's kind of like the same looking at stochastics above 80, below 20, that kind of deal. I'm not using stochastics, I'm just using price. I double the ATR. If the ATR is 2 points, then I shouldn't be entering more than 4 points, and so on and so on and so on. Okay? Does that make sense? Double the ATR. You know, Walter, the ATR is can't really use the ATR on range bars because it's always going to be 4, right? So it's going to be 4 ticks, 1 point, right? So you can't really use the ATR the same way that I do because it is a range chart, right? It's always going. The ATR is always going to be 4 ticks. Right, and you look for pullback or strength trades. That's right. All right, very good. All right, so let's talk a little bit about the January effect here. I'll explain to you what this is all about. The beginning of the year in January 2012, and the same thing now in January 2013, I want you all to look at something. I want to teach you something that's been used, at least it was used every year that I worked at the firm, that we would predict for a longer term hold what the year would turn out to be. Okay, we would look at price of what happened in the first month of the year. Now, obviously, being a money manager, it's a little bit different than day trading because you're holding on to positions for months on end. But the idea is really the same, right? We're looking at price and we're determining what is going to happen into the future. So this January effect is all about looking at what happens in the first month of every year. We used to do this all the time. We still do, or I still do, and they still do as well. And so what happens is if there's an up month, January is higher close than open, then I would expect that the year would be an up year. Now, you can go back in history, and you can probably verify this yourself, and you can say, because there's evidence of this that says every year that January was higher close than open, the price went higher. So this is a strategy of holding on to a trade. I'm not saying enter February 1st. What I'm saying is look at an opportunity to go long on pullbacks, or if it breaks the highs of the year, right? So let's say January puts a high. I'll give you an example here. Okay. So you have the market starting off here in January, and this is what January looks like. Open, close, right? Bar chart. So I already know that the year should look like that. Maybe not this strong, maybe stronger, but I do know that January will be, or the year will be up year, high percentage of the time. It's proof. There's proof that this exists. Okay, so I'm not saying February 1st buy, right? Because who knows? It may go down, it may range a little bit, it may go lower, and then June rolls around and starts going higher. So what I'm suggesting to everyone is wait until price pulls back, or at least begins to break the January highs, proving that this January effect is actually happening. You don't have to just jump in, call your broker and say, John Paul says January effect, February 1st, buy 100. I don't want you to do that. What I want you to do is I want you to think about an opportunity to go long. Why not go long once it breaks the highs of the month of January? There's my proof. It starts to break. Boom, I'm long. I did it this year. I put 3 or 4 blog posts. You can go back on my blog and just type in January effect. And you're going to see that I said, hey, everyone, buy E-mini S&P or buy the market. We're going higher. And then it pulled back and it started to go higher. After pulling back, I said, put on the blog post, and I said, buy the E-mini S&P. It's going higher. It went higher. Then we have this fiscal cliff talk. The market's still going higher. If you bought at those times, or if you bought at the end of January, or if you were selective with these pullbacks, look at where we are. High of the year. So think about that. January 2013 is coming around. Let's wait to see what happens. If it's a break even or if it's a lower close, then there's no January effect. But if it's a higher close and open, I would say options. I'm not a big options guy, but you have options. You have stocks for you guys who like to hold on to stocks, or wait until it breaks the January high anytime throughout the year, you're in. Questions on that? Yeah, Jeff, exactly. You can't use the ATR with a range chart, right? Because if you have whatever range chart you're using, it's always going to be the same ATR, right? It's always 4 ticks. So I was actually explaining that to Walter. All right. One other thing that I look at, and it doesn't have anything to do with it, but I'm just going to give you this little tidbit of information, is what happens on, and believe me when I say this, 100% 100% correct is 100% correct. Okay, so there's no denying those odds, right? Only higher, Bob. Only higher, Bob. Any year, and you can go back until 1800s, start of the market. Any year ending in a 5 is an up year. Now I know it may be a little bit early to tell you this because we're in only the year 2013 now, coming up. But in 2015, I'm going to buy, because every year that ended in a 5 was an up year from the start of the recorded history of the market. So write it down. I'm sure it'll be here in 2015. I'll mention it again. 2015, 2005, 1995, 85, 75, 65. They're all up years. Great opportunity to put some money away for your kids' college tuition. I have no idea. The Trader's Almanac could be. I don't think so. But I mean, if you can, yeah. There's, I have some historical charts here in big format here that I pull out and just charts of years. They look like blueprints of houses or big charts, and you can go back and, yeah, absolutely, Finley. I don't know about the Trader's Almanac, but you should be able to find that information. Yeah. Gold. You got it, Finley. Yeah, absolutely. So let's take a look at gold. I think we're trading the February, is it? Gold. I'll put up the gold. How do you usually trade gold, Mike? What time frame do you use? Thanks. Thank you, Paul. Mike. 5-minute chart. All right, let's take a look at a 5-minute chart here and see what the Atlas line did on gold. Okay, so here's gold. Remember, I don't want you guys to think that this is you have to sit and wait around for the orders to appear. I want you to understand what the orders are. So again, it's the same. 2 consecutive closes. 1, 2. Above or below the Atlas line will provide you the initial signal, the double bar long. So 1651 or double bar short. 1651.80. This should coincide 1651.80. It is exactly 1651.80. And you manage it the same way, right? 4 bars, time-based stop, catastrophic stop, prove it stop, right? Nothing changes. Mike? Any questions? Crude oil should be similar. I don't know. Let's see. Take a look at the crude oil. It's January? I'm not sure if it's January or February. I think we may be in February with the crude. I don't think I've updated, but this is the January crude oil. February? I'll add it here. I'm not a big gold trader or crude oil trader. only because I think the markets are more manipulated than the E-mini S&P. There's lots of manipulation that happens in the markets, but those markets, they are really manipulated. Let me add the so let me tell you while I add here the crude oil to my instrument list here, what's happening at DayTradeToWin. What we're doing at DayTradeToWin, we're trying to, or I'm trying to, educate traders on how to start the day off and know what to do. Whether it be the Atlas line, whether it be the at the open, or the power price action method, which is called the blueprint, or the X5, or the roadmap, or any of those things. And what I'm trying to do is I'm trying to educate traders to stay away from conventional indicators because they're all really based on the same thing, moving averages and moving average. But if you concentrate on price, now it's a little bit different story. Okay. So let's go with crude oil to February here. And so in January 15th, we have another group class starting. Those of you who may be interested, I just want to let you know that in 2 weeks from now, more or less 2-3 weeks from now, for January 15th, we start a new class. Okay. So here is the crude oil. Okay, to go short, if you go short here, 2 consecutive closes, this is your prove it stop. The first close on the opposite side. So there's on crude oil. Let's see what happened with crude the day before. Crude oil gave you a long there the day before, and here's a nice long here on the 19th, and here is, I'm just scrolling back. I'm not picking and choosing days. I'm just scrolling back to show you what happened. These are strength trades and pullback trades. Long, short. Got it, Finley. Price is king. Roadmap is based on manipulation. Finley. I'm using NinjaTrader. You can download it for free, ninjatrader.com. And I like it. It's simple. It's easy. The free version includes live data. Can't go wrong. All right, very good. So I want to wish everyone a Merry Christmas, Happy New Year, Kwanzaa, Hanukkah. For George Costanza, we have Festivus for you guys. I'll try to do another webinar maybe next week. Give you some insight on more on what I do. The coupon is 15 holiday, right? Coupon code is 15 holiday for 15% off. And the new class starts January 15th for the mentorship, which is 8 weeks. If you have any questions, you can call me. You can email me. I'm pretty good with email. You can call me. I usually have to call you back. And I'm pretty good with the calls too. All right. Anyone have any final questions? You got it, Nathan. Jay, David, Merry Christmas to you as well. Yeah, you can send me an... I can't do it right now, Walter. But you can call me later in the afternoon, or actually email me a good time. Okay. They work on TradeStation as well, RoadRat. Right? You got it, Finley. I will look at that as well. You got it, Babek. Have a good one. TradeStation, they are coded in TradeStation as well. Yes, absolutely. You got it, Kevin. TradeStation, NinjaTrader, and eSignal, the Atlas line is available for. And the at the open as well. All right, guys. Take care. Bye-bye now.